Hey guys, today we're going to add on to our Putting It All Together Eco Review book. We're going to be focusing on things like monetary policy today. So, the very first thing we're going to cover is M's, all the different types of money categories. So, this would be a good half page thing. So, if you have a half of a page or the back of a page, if you want to work on, we'll talk about the different types of categories of the M's, all the different monies. And so let's keep in mind that M1 to M3, you know what? I'm actually going to add on to this. Instead of M1 to M3, I'm going to say the monetary base to M3 ranges from highly liquid, high in terms of liquidity, to lower liquidity items. Lower liquidity. The idea of liquidity is how readily available this type of money can be converted into cash in order to be spent. So, like, basically, how fast can I spend it? Is there a waiting period? Do I have to wait, or can I spend it? Can I use this as a medium of exchange very, very quickly? Obviously, cash and coins are the highest liquid because they're already transferred and converted into cash and coins. They're already cash and coins. So, they're the highest liquidity. So, let's talk about the M's in terms of the different categories. So, I'm going to write it like this first. M1 is included in M2, and M3 includes basically everything. But notice how earlier I said monetary base. Monetary base is just the cash and coins in circulation. So it is the physical cash and coins that are actually in circulation. That's the monetary base. So it's the most highest liquidity because it's just cash and coins. M1 includes this. M1 is the highest liquidity, but it includes cash and coins. So it includes the monetary base. It includes anything in a checkable deposit. That means a checking account. A checkable deposit. So checkable deposit, checking account, that means the same thing. They also might call this a demand deposit. That's a checking account. Anything connected to your checking account, like, checks, debit cards, or traveler's checks. These are all types of M1. So very, very high liquidity. You can spend any of these at the grocery store buying things very, very quickly. So M1 is also in M2. So M2 includes everything in M1 plus lower liquidity assets. This is not all that calibrated. So there we go. Plus savings accounts. Small time deposits. Small time deposit. Time deposit is a CD, a certificate of deposit. It's like a savings account, but like a savings account, you can only access it maybe 3 times a month, with not very much interest. CDs earn a little bit higher interest, but the trade-off is you can't access it but maybe once every 3 months. And there are different levels of CDs. There's like a 3-month CD, there can be a 3-year CD. They can range in terms of how long before you can access it. They range in liquidity. So small time deposits, so small time, maybe about 3 months, 6 months, are going to be an M2. Business accounts, it's like a business checking account, are also in M2. Those are the main big things in M2. And M3 includes everything in M1 plus everything in M2, and then even lower liquidity assets like a large time deposit, a long time CD, large time deposit, a money market account, and just think of like a retirement accounts. very hard to access. You have to wait years sometimes to access these types of accounts. So M3 is the lowest liquidity. So what is something that changes M1, M2, and M3? So going backwards, maybe there's M3. Okay. So if, and then it kind of just expands in terms of liquidity. So M1, M2, M3. So let's say the Federal Reserve sells bonds. They sell bonds to banks who then take their excess reserves to pay for them. So like the Federal Reserve sells the bond to banks, to commercial banks. The banks will then take money out of excess reserves to pay for it and then send that money to pay for the bond to the Fed. So the bank gets a bond and the Federal Reserve gets money. And that takes money out of circulation. So it decreases money out of M1, which then decreases the whole, like all the circles, because M1 is included in everything. So something that would affect all of these M's is if the Federal Reserve does some sort of policy. If the Fed sells bonds, then all like M1 goes down, so all the M's go down. If the Fed buys bonds, since that's expansionary, all of the M's go up. There's more money supply. But there are certain transactions that we do as like people that are going to affect one and not the other. So how they're all affected, how all M1, M2, and M3 are affected is by monetary policy, either expansionary, more M's, or contractionary, less M's. But sometimes the situation would be like, Miss Taylor withdraws $200 from her savings account in the form of cash. So there's savings is in M2 and cash is in M1. So I take $200 out of my savings account. So M2 goes down by $200. Well, M1, I just converted it from savings to cash, and cash is in M1. So plus 200 in cash in M1. But the question is, well, what happened to each of these three M's? Well, if you look at the M1 circle, it looks like it increased by $200. So M1, in that example, increased because now it was savings, now it's cash, which is in M1. M2, the first gut reaction is to say M2 fell. But here's the thing about M1, M2, and M3. Anything that happens to M1 is also happening to M2 because M1 is included in M2. Everything that happens in M2 is also happening to M3. And by that standard, everything in M1 is also happening to M3. So even though M1 went up, that is not necessarily like that transaction of M1 going up is also included in M2. So while M2 fell by 200, M1 increased by 200, all of M2 stayed the same because they recorded that minus of 200 and plus of 200 is all happening still in M2. So while M1 went up, M2 stayed the same, and as well as M3, that stayed the same because it just transferred from one type of M to another, but that transaction includes what happened in M1 as well. So those are kind of like weird scenarios of like when something changes, does it ripple out? Does it have an effect? So those are the M's. Now let's next talk about the money market graph. You can put this on a new page. First, let's say what it illustrates. The money market graph shows the supply and demand of money in circulation. So here is what the money market graph looks like. On the y-axis is nominal interest rates. On the x-axis is the quantity of money. The money demand curve is downward sloping, labeled money demand, DM or MD is fine. And money supply is vertical, labeled MS. Where they intersect is equilibrium, but that equilibrium right there, that actually has a name. That nominal interest rate of equilibrium is the federal funds rate. federal funds rate is the interest rate that banks, commercial banks charge each other for overnight lending, for overnight loans. It's the interest rate that banks charge each other. Okay, so money supply is vertical because that's like the set dollar amount. It is not influenced by the interest rate. It's like how much money like treasury actually like printed. It's like how much money they actually have. So that's like that basically it's M1, which is a dollar amount, and it's not dependent on the nominal interest rate. It's just whatever is available. Money demand is downward sloping for basically two reasons. So money demand is downward sloping, meaning that nominal interest rates, when they increase, the quantity of money decreases, and when nominal interest rates decrease, the quantity of money increases. They're inversely related for two reasons. And the two reasons is the idea of transaction demand and asset demand. So here I'll move myself to right there. So money demand is downward sloping because as nominal interest rates, let's say, decrease, you're not earning any interest, then people demand money for transactions to buy things rather than as an asset in a bank. Meaning, if interest rates are low, I'm not earning any money in a savings account, and so I'm going to not keep my money as an asset, as a savings account, like as an investment. I rather have it for transactions to buy things, and so there's now more money in circulation, and not in the bank. So there's more money in circulation because I'm keeping it in my pocket for transactions. I'm not keeping it in the bank because interest rates are too low. It's not an incentive. There's more incentives to keep my money in my pocket rather than in the bank because the interest rate's too low. But as soon as interest rates go up, let's say the nominal interest rate increases, now there's more demand for money as an asset. There's more asset demand. And there's less demand for money as transactions because I rather keep my money in a bank if interest rates are high. So I'm not going to keep my money for transactions. I'm going to take it out of circulation and put it in the bank and have my money as an asset, as a way to, as a savings account, as a way to make money. So there's more demand for money as assets, less demand for transactions or money as transactions. I'm running out of room, and therefore there's less money in circulation. So that just explains the negative relationship. So it's either if interest rates are high, there's more demand for money as an asset, which means less quantity of money in circulation because I'm keeping my money in the bank. If interest rates are low, then there's more money in circulation, as I rather have my money for transactions rather than assets because there's no interest to be earned. So this is an example of why the money demand curve is downward sloping. Let's talk about what shifts money supply and money demand. So I'm going to redraw this, and then I will, I'm going to have two. I'm going to have two money market graphs. Ooh, I almost made a vertical. You don't want to do that. Okay, so expansionary monetary policy and contractionary monetary policy is what shift money supply. More specifically, the buying and selling of bonds. That's their primary monetary policy tool. And when the Fed buys bonds, they're buying them from the banks and giving the banks money for those bonds. So they're taking the bonds away from the banks, they're buying it from them, and they're exchanging and giving them more money to put in their excess reserves. So money supply increases and shifts to the right when the Fed buys bonds, and that lowers the federal funds rate. That makes banks able to borrow more money from other banks and just increases lending just overall, and there's more money supply in the circulation. But the Federal Reserve, if they sell bonds, that's contractionary because they are selling bonds and taking money out of circulation, and money supply decreases and shifts to the left. And that raises the federal funds rate and lowers the quantity of money in circulation. That is what shifts money supply. We have yet to talk about what shifts money demand, because frankly, it's not huge on the test. They mainly have Federal Reserve and actual monetary policy shifting the graphs, but we need to talk about what changes money demand. So money demand shifts. I didn't give yourself a title up here. You can say shifts of money supply. Money supply shifts. So that was money supply shifts. Now we can talk about what shifts money demand. And so once again, I'm going to draw two graphs, and then I'm going to have some explanation. So here we have a money market graph again. And what would shift money supply money demand to the right and money demand to the left? So here I'm going to move myself really quick to get myself out of the way. Here we go. Splendid. So here we have money demand. So technically, money demand shifts whenever there is more or less spending. There's a change of spending. So think of the shifters of aggregate demand, CIGXN. So basically, in some alternate universe, every time that you were shifting aggregate demand to the right, so was money demand shifting to the right. Because think about every time you reach for your wallet, money demand shifts to the right. Every time you're like, you know what, I don't need to buy that, then money demand is shifting to the left. And so this is caused by more spending. When money demand shifts to the right, that is because people are spending more money. So an increase in spending. You know what? It's technically an increase in spending cash. Because this is money, like this is the supply of money in circulation of like M1. So spending basically in cash. You reach for your wallet to pull out a 20, that's more money demand. When there's a decrease in money demand, that is caused by less spending in cash. So this is a decrease in spending, basically as in cash. So if aggregate demand decreases, so does money demand. If aggregate demand increases, so does money demand. So the aggregate demand shifters are the same things that shift money demand. So either C, I, G, or XN going down. Oh, actually that was going up question. If any of those increase, then it's going to shift money demand to the right. If any of these decrease, C, I, G, X, N, then that is going to decrease money demand. So just make sure that we're drawing our equilibriums in the right spot. But that is what shifts money supply up top and then money demand right here. Now that money market is kind of over, let's do our last thing, which is monetary policy, which we've kind of been talking about. It's kind of hard to talk about M's, and it's kind of hard to talk about, especially the money market graph, without mentioning monetary policy. Monetary policy. So, monetary policy is the regulation of money supply. It's done by the Federal Reserve to help with fluctuations in the business cycle. So we're trying to get out of a recession, or maybe trying to stop inflation, and we're going to manipulate money supply. We're going to manipulate interest rates to do that. So I'm not going to say money supply specifically. I'm going to say interest rates. I think that it's a better choice of wording. But the changing of interest rates. The changing of interest rates to stabilize the fluctuations in the business cycle. So there's expansionary monetary policy if you need to expand the economy, and there's contractionary monetary policy if you need to contract the economy. But we've been talking about so far discretionary monetary policy. We have yet to talk about automatic monetary policy, because the monetary policy unit, when we do it, it's like 3 weeks long, and it's just a lot of material, from the Federal Reserve to EMS to bank balance sheets, and it's a lot of stuff. So I always kind of throw off the automatic part of monetary policy till review, because otherwise it's just overload of information. So I kind of break it up. So here's what we're going to do. There is, I guess we can do a new page. Let's do expansionary on one side. It's big T chart, like a big T chart. Expansionary monetary policy and contractionary monetary policy. Expansionary monetary policy, by definition, lowers interest rates to increase aggregate demand. I'll just do AB. To increase aggregate demand. You want to do this in a period of a recession. You do this during a recession to get out of the recession. Contractionary monetary policy increases the interest rates to decrease aggregate demand. So expansionary fixes a recession, while contractionary monetary policy fixes inflation. Okay, so let's talk about when the Federal Reserve actually purposely does monetary policy. So let's talk about discretionary monetary policy. That's expansionary, and discretionary monetary policy, that's contractionary. Okay, that means they do it on purpose. That means they are purposely buying and selling bonds, purposely changing the discount rate, and purposely changing the required reserve ratio. And so if you're doing it on purpose to expand the economy, the three tools of discretionary expansionary monetary policy are the buying of bonds. When the Fed buys bonds, lowers the discount rate, which I'm going to pause here right now and actually define what discount rate is. The discount rate is the interest rate that the Fed charges for loans. And lowering the required reserve ratio. The required reserve ratio is a percent of deposits that must be kept in reserves. That must be kept in reserves. Okay, so this is all done on purpose by the Federal Reserve. They buy bonds, that increases money supply, they lower the discount rate, or they lower the required reserve ratio. All of these increase money supply. So I'm going to draw a cute little, doesn't have to be super big, nominal interest rate, quantity of money, money supply, money demand. And these actions of the Federal Reserve increase money supply, which lowers the nominal interest rate. And that right there will increase aggregate demand. And so this lower interest rates increase aggregate demand, and bam, we are out of a recession. Of course, in a period of inflation, we're going to do the exact opposite. The Federal Reserve will do the exact opposite with those tools. So instead of buying bonds, the Federal Reserve will sell bonds on the open market. Remember, bonds are also called securities or open market operations. Those are the big names that they're going to use interchangeably. So bonds, securities, open market operations, all of those means the buying and selling of bonds. In this case, if we're trying to contract the economy, they're going to sell bonds. Or they could raise the required reserve ratio. Or the Federal Reserve, I'm about to write something else, I don't know. Or the Federal Reserve is going to increase the discount rate. Either way, either of these tools that they use is going to decrease money supply. So here we have another little money market graph. Selling bonds, raising the discount rate, or raising the required reserve ratio is going to decrease money supply. Money supply shifts to the right. That raises the interest rate. And that right there, raising interest rates, higher interest rates cause aggregate demand to fall. Businesses take out less loans if it's more expensive to take out loans. And over here, businesses will take out more loans and spend more money if it's cheaper to take out a loan. Well, all of these things are done on purpose by the Federal Reserve. Whether they're buying or selling bonds, they're doing that on purpose. That's what makes it discretionary. They're doing it by their own discretion, by their own choices. They can expand on purpose or contract the economy on purpose. But even if they didn't, just like with fiscal policy, there's like an automatic fiscal policy with like tax brackets and with like welfare and things like that. There's the same thing that works like that for monetary policy, where interest rates are naturally going to go up and down, or I don't want to say the word naturally, but automatically go up and down, even without the Federal Reserve having any type of purposeful policy. So it's just going to happen on their own. So it's not the natural fixer, it's an automatic fixer. Automatic means the policy tools are still happening just automatically. That natural thing, that's the whole idea with wages. That's not what I'm talking about. I'm talking about still interest rates are going to change, but this time automatically without any sort of intervention. So this is automatic expansionary on the left-hand side and automatic contractionary on the right-hand side. So automatic monetary policy, that happens to be expansionary, and automatic monetary policy, that is contractionary. So I know that the titles are way up there, but I'm going to write expansionary so we remember that this is the expansionary side and then this is the contractionary side. Expansionary and contractionary. Okay, so about expansionary monetary policy. This happens during a period, like this needs to happen during a recession. So in a recession, which I'm going to just quickly draw on an aggregate supply and demand graph. This should be easy by now. In a recession, there's less spending because people don't have a job, because prices are falling and they're always waiting for the lower price. There's just less spending because there's just less money flowing around. It's a recession. And so didn't we just talk about how spending is what shifts the money demand curve? That every time that aggregate demand shifts, so does money demand? Well, think about what caused the recession. It's less spending. People not spending their money. less consumption, less investment spending. And so aggregate demand falls, which then causes money demand to fall. And look what happens with interest rates when money demand falls. If there's less spending, pretend that they're not doing anything with bonds. They're not doing anything with the required reserve ratio. They're just leaving it alone. But even if there's less spending means less demand for money. You know, if reaching for your wallet is what money demand is, you know what poor people don't do? They don't reach for their wallet. There's no point. There's no money in there. And so if you don't have a job, you're not going to go out and buy stuff, which means there's less demand for money in the economy. And look what happened to interest rates. Bam, lower interest rates automatically without like the Federal Reserve doing anything. Interest rates are going to just fall automatically on their own. And that right there is what boosts aggregate demand back up as people take out more loans because now it's cheaper to do so. So I couldn't afford to take out a loan, but with those interest rates, now I can. And so those lower interest rates increase aggregate demand automatically. There's less demand for money, and that lowers the interest rates, and then aggregate demand is going to shift back to the right, closing our recessionary gap. So whether the Congress does something or nothing, we're still going to have fiscal policy. Whether the Federal Reserve does something or nothing, we're still going to have monetary policy. And even if their nothings don't work, we still have that whole idea of like wages being the natural fixer. So there's something for everybody. So here we have automatic, this time contractionary monetary policy, where it's during inflation. During inflation, there's more spending. Because, well, first off, you have to spend more because prices are high, and you have to spend more because, well, that's what causes the inflation to begin with, is there's too much spending. So here I'm going to draw it on another aggregate supply and demand graph really quickly. Look at all that spending. More aggregate demand, which means higher prices, which means more reaching for my wallet to pay for those higher prices. Of course, if I reach for my wallet, that's going to increase money demand. Now, I'm reaching for my wallet to pay for those high prices because it's a period during inflation. Money demand shifts to the right. That right there is what raises the interest rate. And then that's what slows down spending. There's monetary policy right there. Didn't we just say it's a change of interest rates to stabilize the economy? Now the economy will stabilize because those higher interest rates are going to bring the spending back down to a reasonable level. And so the higher interest rates will actually lower aggregate demand and shift aggregate demand back to the left, back to equilibrium in the long run. So here we have interest rates changing on purpose is discretionary monetary policy. By accident, just automatically, is still monetary policy, but just automatic monetary policy. And it can go one of two ways. It can expand the economy and shift aggregate demand to the right because of lower interest rates, or it can contract the economy and shift aggregate demand to the left with higher interest rates. Either way, the economy will adjust. And that's the end of today's notes. Hopefully it wasn't too long, but we did M's, we did the money market graph, and automatic versus discretionary monetary policy. Tomorrow we will do fiscal policy, so watch out.